Okay, let's just dive right into this. You know the scene, right? It's late, you're scrolling through Zillow, and every single house that isn't literally a pile of sticks just seems like a financial fantasy. The kitchens are a throwback to the early 2000s, the carpet has seen better days, and the listing still has the nerve to call it a starter home.
And you're sitting there thinking, I've done everything right. You've got a good salary, you've been saving up, but actually owning a home feels completely impossible. You start to wonder, what am I missing? Am I the only one who can't figure this out? It is an incredibly frustrating feeling, and trust me, you are not alone.
And this is where things get really confusing. The bank sends you a pre-approval letter for some huge, unbelievable number. Your real estate agent is all smiles, telling you it's a great time to buy. Everybody seems to think this is a fantastic idea. So, what's the problem?
Well, here's the problem, the cold, hard truth. You can't actually afford that house. Not in a way that doesn't turn your life into a non-stop financial stress fest for the next 30 years. And today, we're gonna break down the real numbers, the ones the real estate industry would rather you didn't look at too closely.
It all starts with what I call the affordability illusion. See, there's this massive gap between what the bank tells you can borrow and what you can actually afford without being miserable. So here's the absolute key to understanding this. Solid financial advice, the kind that helps you sleep at night, says you should keep your housing costs under 28% of your gross income. But the bank? Oh, they play by a totally different rule book. They'll approve you as long as your total debt, we're talking mortgage, car loans, student loans, the whole shebang, is under 43%. See the difference in goals? Your goal is comfort. Their goal is just to make sure you don't default, at least not right away. That 43% isn't a friendly suggestion, it's the absolute maximum stress they think you can handle before you financially snap. All right, let's roll up our sleeves and get into the real numbers, because this is where the pretty picture starts to fall apart.
Okay, so we're gonna use a $400,000 house as our example, which, by the way, is actually less than the national median price, so this isn't some crazy fantasy scenario. Let's say you've worked hard and scraped together a 10% down payment, that's 40 grand. This leaves you with a loan of $360,000 at about a 6.09% interest rate.
So you plug that into a calculator and out pops this number, $2,150 a month. Okay, that's the basic principle in interest. It's the number Zillow shows you, it's the number most people fixate on, but, and this is a huge but, we are not even close to being done. Now let's start stacking on all the other costs they don't exactly advertise. First up, property taxes. We'll be conservative and say that's another $450 a month. Then you need homeowners insurance. Tack on another $300. And because you put down less than 20%, you get to pay something called private mortgage insurance, or PMI. That's another $275 a month just to protect the bank. And finally, the big one everyone forgets, maintenance. Things will break. The water heater will go, the roof will leak. You need to budget for that, let's say about $333 a month. You add all of that up, and your actual monthly housing cost is over $3,500. That's more than $1,300 higher than that first number we saw. It's a 60% increase. So, what kind of salary do you need for this? Well, to comfortably afford this home, using that safe 28% rule, you need to be making $150,000 a year. But the bank, using their risky 43% rule, they probably sign off on you making as little as $98,000. That is a $52,000 gap between what's smart and what the bank calls qualified. And this chart really just says it all. Only about 20% of American households even earn $150,000 a year or more. So think about what that means. A below median priced home is financially out of reach for 80% of the country, if you want to live with any kind of financial breathing room. It's wild. This just begs the question, right? Why does it feel so much harder for us now than it was for, say, our parents? Well, the answer is in this thing called the generational gap, and it's a huge shift in the basic economics of buying a house.
So get this, back in 1980, the median home cost about 3 times what the median family earned in a year. It was a stretch, yeah, but it was a doable stretch. Fast forward to today, the median home costs 5 times the median income. The basic math, the relationship between what we earn and what a house costs, it's broken. And this chart just puts it in the starkest terms possible. Our parents' generation was asked to buy a house that cost about 3 years of their salary. We're being asked to buy one that costs 5 years of ours, all while juggling way more student debt and other costs they never had to deal with. The goalposts have completely moved. And this leads to a term you've probably heard thrown around, house poor. It's that awful situation where you technically own an asset, the house, but you have no actual money left to, live. You can't save, you can't go on vacation. Every time the car makes a funny noise, it's a full-blown financial crisis. So the natural next thought is, okay, fine. I'll just wait for the market to crash, then I'll swoop in. It's a nice thought, it's a common hope, but unfortunately, all the data suggests that's probably not going to happen. And here's the biggest reason why. A staggering 81% of people who currently have a mortgage have an interest rate below 6%. A huge chunk of those are way down at 3% or even less. They are locked into these amazing rates. Why on earth would they sell their home, give up that rate, and buy a new one at today's prices and much higher rates? They won't. This keeps the supply of houses for sale incredibly low, which keeps prices high. Now, here's a fact that I hope makes you feel a little bit better, a little more sane about your current situation. Right now, in every single one of the 50 largest metro areas in the entire US, it is mathematically cheaper to rent than it is to buy. So if you feel like you're throwing money away on rent, stop. You're not. In this market, you're actually making the most rational, smartest financial choice. Okay, so the situation is tough. We've established that. But this does not mean you're powerless. So let's shift gears from the problem and start talking about the solutions. This is your new home buying playbook. You've really got 4 main strategies. 1, you can move. Seriously, some parts of the country are just way more affordable than others. 2, you can buy less house. Adjust those expectations. Maybe it's smaller, maybe it needs a little work. 3, you can house hack. Buy a duplex and rent one side out, or get a roommate. Let someone else help pay your mortgage. Or 4, and this is a totally powerful and valid option, you can just wait. Keep renting, save like a maniac, and let your income grow. There's no prize for buying a house that makes you miserable. And if you take nothing else away from this, take this. You are not failing. Let me repeat that, because it's important. You are not failing. Home prices have just outrun wage growth so dramatically that what was achievable for our parents' generation has now become a luxury item. The system has changed. So the question you should be asking isn't, can I technically get a bank to approve me for a loan? The real question is, will owning that house with all of its real costs and financial pressures actually make my life better? Because choosing what's right for you based on the real math, that isn't failure. That is financial intelligence. That's winning.